what we're seeing is we are seeing the establishment panic. And by the establishment, I mean particularly, this is noticeable on COMEX. What they did over sort of second half of January, first half of February, was they tried to cover their positions. And so we had a situation where open interest on COMEX fell by something like 75,000 contracts, while the price rose over $200. I think, I mean, all you need do is have a look at the charts, and you can see that gold is sort of pretty much in runaway mode. Now, it's quite natural in human terms to think, oh, hold on, it's gone up to, and it's getting close to $3,000. And, surely that's a big number hurdle. And, it's got to maybe consolidate a bit before it goes through there and all the rest of it. Yeah, it's all true.
The establishment on COMEX is panicking, as evidenced by a drop of about 75,000 contracts in open interest, while gold prices surged over $200 during late January and early February. This bear squeeze has propelled gold into runaway mode, nearing the $3,000 mark, though a brief consolidation might occur before it continues upward. The speaker, Alasdair Macleod, a renowned economist and financial analyst, explains that the Dixie reflects credit relationships between the dollar and other currencies, not gold, and argues that Trump's trade policies are reducing foreign demand for dollars. This is evident as the Dixie index has fallen from 110 to 106. However, if confidence in credit deteriorates relative to gold, the Dixie might rebound. He warns that isolationist trade measures and potential tariffs, reminiscent of the Smoot-Hawley era, could burst the largest credit bubble in history, repeating a crisis like that of 1929, but without the stabilizing effect of the gold standard, which would be disastrous for the global economy. Alasdair Macleod points out that gold is unlikely to be hit by tariffs, since it's classified as a top-tier asset that the banking system would never compromise. Although pre-office proposals from Trump's team, like those from Besant, touted aggressive gold strategies, officials will prioritize the dollar's credibility by keeping gold out of the system once the Treasury takes over. Likewise, issuing long-term gold convertible bonds is impractical because the Treasury wants to protect dollars backed by gold rather than expose gold to market risks. As you watch these clips, we encourage you to like this video, subscribe to our channel, and hit the notification bell so you're instantly alerted whenever we post new content. We appreciate your support and hope you enjoy the video.
Well, first of all, the Dixie has got nothing to do with gold. The Dixie is a relationship between the dollar and other currencies, not gold. So we're talking about credit relationships in the case of Dixie. Now, I mean, what I would say, however, is that there is an awful lot of foreign ownership of dollars. Trump's trade policies means that the requirement to hold dollars, if you like, to settle international trade, on balance is likely to diminish for foreigners. So they are likely, I think at the least, not to have further demand for dollars. So that probably explains why the Dixie has come back from that 110 level to currently 106 and change or whatever. As for where the dollar goes from there, I mean, quite frankly, if we see a further deterioration in the general confidence in credit relative to gold, then I would guess that Dixie would recover against the other currencies, simply because, Steve Hanke says it's the least dirty shirt in the laundry. So on that basis, I think to look at the Dixie is actually the wrong way of looking at it. It really is. There are bigger things afoot, I think, which are likely to undermine the value of credit. I mean, not least Trump's policy of isolating America from the rest of the world in trade terms. That has got serious consequences. It's got serious consequences for the global economy. Now, China has actually insulated herself from this. But if you look at, the European economies in particular, they do a lot of trade with America and, tariffs. And only yesterday I saw something, I don't know whether it's true, something to the effect that Trump said that, no, he was going to impose 25% tariffs on Canada and Mexico. That's happening, he's sort of thing. This sort of business basically is very bad for the global economy, and certainly for economies which trade with America. I mean, this is a repeat of Smoot-Hawley in 1930, which, coupled with the popping of a bubble, which is actually, we've got the biggest bubble ever now, if you only stood back and tried to look at it, credit sensibly. This is the biggest credit bubble in human history. So combination of that and trade tariffs. I mean, you've got 1929 all over again without the gold standard. So this is not good. This is not good. I think it's unlikely that gold would be included in tariffs because it's a class one asset. You get the banking system would turn around and say, look, no way. It's as simple as that. Not only that, but most of these stories came from Trump's team before they assumed office, and it's all very well, someone like Besant, who's a hedge fund trader, saying, I'm bullish of gold and all the rest of it. And when I become Treasury Secretary, I'm going to do this, do that, and all the rest of it. But as soon as he gets into those gilded portals of the US Treasury, the permanent officials will take him to one side and say, look, this is the reality of the situation. The reality of the situation is we do not want to undermine the credibility of the dollar. Don't talk about gold. It's off limits. Quite simple. And when it comes to and this explains how he's sort of turned around. Of course, I mean this always happens, this business of a 50 or 100-year gold convertible bond, forget it. That's not going to happen either because what are you dealing with? You're dealing with dollars that need protecting in gold. I mean, this is not the Treasury's narrative. They want to keep gold out of the whole system completely.
Alasdair Macleod highlights that that's a complete hoax. It's not a Treasury initiative, but something the market will eventually drive on its own. With Trump's tariff policies now compounding an already bursting bubble, we're seeing a loss of momentum, especially in tech stocks and other assets closely linked to the Nasdaq. While it hasn't fully manifested yet, the declining momentum suggests the bubble is beginning to deflate. The issue revolves around an enormous credit bubble bound to burst, potentially toppling the stock market and devaluing bank collateral, as happened during the 1930s. Unlike previous crises, we're now dealing with a series of bubbles that have been artificially propped up. During the Great Financial Crisis, the Fed effectively wrote open checks to prevent widespread bank failures. If similar measures were retaken, they could destroy the currency. Geopolitical factors, with leaders like Trump and Macron offering differing approaches, will affect the timing, but the underlying financial imbalance remains a serious threat. Now, let's dive into the interview.
I think with Trump's tariff policies coming on the top of a bubble, I mean, we've seen this bubble is bursting. I mean, I know it hasn't really shown yet in, sort of tech stocks and all the rest of it, but, they seem to be losing momentum. Not only that, but, the momentum seems to be declined in that other asset, which all the tech boys buy and correlates so nicely with NASDAQ, and that is Bitcoin. I mean, that bubble looks like it's bursting too. I mean, Bitcoin is not actually a hedge against credit. Forget it. It's a nothing burger. It's a speculative counter full of very, very dodgy people. I mean, it really is. But the values have been driven by exactly the same factors that have driven the tech bubble. We're seeing that beginning to burst. And when you get the credit bubble bursting, do you stay in credit? No, you get the hell out of it. And that is the whole point about gold. So, you could try and trade gold. And if you're very, very clever and you really know what you're doing and you're, an Elliott Wavist or something like that, good luck to you. But for the vast majority of us, it's actually quite simple. Stay out of credit. The largest credit bubble in history, that will burst. It's quite simple. It'll take down the stock market. It will take down bank collateral values, which was the big problem in the 1930s, and which is why, 5,000-6,000 banks went bust. We've got the same thing happening again. And this time, it's not just the Fed from sort of 1920s, sort of mid 1920s, sort of, fueling the system with credit and all the rest of it, and trying to get a new bill market going, which basically was a hidden form of credit expansion as far as the statistics were concerned. It's not just that. We're talking about a series of bubbles which have never been allowed to pop. I mean, I'll just refer to the last one, what they call the Great Financial Crisis, which I think it'll be renamed after this next one, I can assure you. In the Great Financial Crisis, what did the Fed do? It took out its checkbook and it wrote an open check and it said, here you are, you have as much money as you like, just don't go bust. Did it for the banks, did it for the insurance companies, etc., etc. And I mean, this was obviously for US entities. And the ECB had to do exactly the same thing for Europe. I mean, it lets some go bust, like Cyprus, which was a huge mess. I mean, it really was. We're going to get the Russians who are hiding money there and all the rest of it. And what happened? The Russians actually took their money out in London before the banks in Cyprus had a chance to close. It was just the ordinary holders in banks who got killed by this. I mean, that was just appalling, the whole thing. And then, of course, you had Greece and all. So this was a problem that went on and on and on. But the way in which it was resolved was quite simple. Here is an open check. Don't go bust. This time, if they try that, they will destroy the currency. It's actually as simple as that. So geopolitics might affect the timing of this, but nothing is certain in geopolitics. I mean, you've got Trump and Putin getting together. Trump reckoned he can sort this mess out in no time at all.
These developments underscore a critical juncture in global finance. With gold surging amid a collapsing credit bubble and disruptive trade policies, the market is on the brink of significant shifts that could upend traditional asset relationships. Investors and policymakers must remain vigilant as the interplay between fiscal imbalances and geopolitical factors creates an uncertain and potentially volatile environment. What strategies can investors employ to protect their portfolios against a bursting credit bubble and volatile gold markets? How might further isolationist trade policies influence the balance between fiat currency stability and gold as a safe haven asset? Share your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.